And today we're looking at the tariffs being rolled back and what to learn from a retirement planning perspective. And I'll share an article I was recently interviewed for in Investopedia, headline from the Wall Street Journal that I took a snippet of. The great Trump tariff rollback. President started a trade war with Adam Smith. He lost, meaning that the free market won. The market did not like the drastic tariff rollout, essentially, the way that he did it. Could it have worked in a different way? Sure, the way that maybe he wanted. I don't know, but maybe he got his result and what he wanted, which was to end up with higher tariffs anyways, which are now like about 10% across the board. And if you read his book, The Art of the Deal, that's essentially what he talks about in there, which is creating chaos, exaggerating your first offer, getting people to the table, and then when the dust settles and reality sets in, you end up better off than when you started, but also whoever you're negotiating with feels like they won as well because it was set, bargained down. It's like if you ever watch the videos of the baseball card negotiators, one goes 2,000 higher than what he wants, the other goes 2,000 lower, and they meet in the middle. And some of the best guys are like, let's just cut to the chase and get in the middle. But this wasn't baseball cards. This was people's lives, because 401ks and investment accounts and retirements are at stake, and recessions are at stake, entire global economies, Fortune 500 businesses that are hiring and firing people. So, as a financial advisor, would it have been my preference to not see the extreme, whiplash in the market, and then not see people think that like this could be the beginning of a really bad situation? I would have preferred to avoid that, but. And then here's the little subtitle: rarely has an economic policy been repudiated as soundly and as quickly as President Trump's Liberation Day tariffs, and by Mr. Trump's own hand. So this isn't a political commentary. It's just, let's see what the markets have done. And I'll do a little screen share here, even from US perspective. So it's just the S&P 500 large cap companies. This is year to date. So we're basically back to even, negative 0.42 from where we started. And what can we learn from this? What's a really big takeaway? One is that, man, it sounds easy, stay the course, and it's kind of rote and cliche. And it is, especially if there's financial advisors out there telling people this after the fact. But a good financial advisor, my clients, are prepared, and we have investment policy statements. And I'm not trying to toot my own horn too much here, but I'm just saying that this big drop here starting in February, and then this cliff was, quote unquote, Liberation Day, April 2nd, when the tariffs were announced. This is about 20% of a negative, which is what is categorized as a bear market. And on the way down, there was all kinds of, financial media headlines that were catastrophic in nature. And even pundits, people that are paid to speak about this thing, or just trying to get attention to their services. It was a bleak time. And look how quickly it's already come back to even to where we started. So if you're a long-term investor, the takeaway is, this is just another garden variety correction. Actually, once per year on average, going back, 80 plus years, there's about a negative 14% dip every year. So it's as common as a cold, and we don't freak out when we get a cold. I mean, some of us do. It's uncomfortable, but we know we're going to survive, just like a negative 15%. And that's the average, which means half of them are more than that, half of them are less. So year to date, if you stayed the course, if you invested and tuned out, people say tune out the noise. What noise? Well, it's more in relation to what your plan is, what your investment model is, what you have set out as your target for retirement, what you need, what your numbers are, how much do you need, what's your withdrawal rate, what's your income rate, how many other sources of income do you have. But this graphic is pretty easy one to see, and it's always good to look back on. And I'm not saying by any stretch of the imagination that we're, quote unquote, out of the woods, or it couldn't go back down again the other way. I'm just saying, if you look out long term, this is just normal behavior in S&P 500 investing. Charlie Munger is quoted as saying, if you can't handle a 50% drop, 2 or 3 times in your lifetime, then you don't have the temperament to be invested in stocks, essentially. He's known for being direct and trite, but the takeaway is, you invest, and the stuff that's for the long term, you kind of got to just be able to avoid looking at your statements and looking at your investments every day I'm not saying that you never look at them because you want to be able to be aware. And then the other takeaway here is the power, again, of diversification. And again, that's just a common thing we hear in financial articles and financial books. But this is a screenshot of year to date. The international, just one international index. I'm not recommending anything, obviously, as far as investment goes, but this is developed world, one developed world index that takes out the US companies. And look how much better it's done year to date, 13.3%. It, of course, experienced the dip on the announcement of the tariffs in April and even a little bit before, but how quickly it's come back up and it's performed, magnitudes better than the US the US stocks. And before this year, you can look back and listen to a lot of the financial media chatter and pundits and commentators and articles about how maybe international investing is dead and we shouldn't put it in the clients' portfolios or in your own portfolio anymore because it's lagged US so much. And the Mag 7 companies, which is all the big US tech companies like Nvidia and Microsoft and Amazon and Google and Tesla, have been shooting the lights out and doing such a good job compared to everywhere else in the world. Why not just pile in to the US companies only and forget this diversification thing because it's not working? Well, of course, the moment everyone thinks the market's going to zig, it zags and does the opposite. The market does what will make the most amount of people wrong, is a quote. So the year that everyone probably tried to pile into US companies is the year that, of course, international starts to make its comeback. Now, of course, it has lagged US there, over the past decade, really, maybe even more. But you just never know when it's going to flip. And if you're investing for retirement, which is 30 years plus in retirement, and who knows how much beforehand. So if you're, in your 30s, 40s, 50s, and you retire in your 60s, that's decades. And then hopefully you live a nice long life. Married couples, on average, someone's going to live, if they're healthy, probably close to 90. That's another 3 decades. And then if there's inheritance involved, who knows how much that's going to be invested, how long, by your kids or your heirs or whoever it goes to. So the point is that 10 years is not a long enough time to eschew one major category of being able to diversify. And if you stayed the course and maintained your model rebalancing, then, this is, again, a garden variety correction. And it didn't feel like it in the moment, but none of them ever feel like that in the moment in terms of the calamity or the catastrophe or the tragedy, whatever the scenario is, whether it's tariffs or before this, inflation scares, lockdowns, COVID-19, the great financial crisis, and the loan and lending debacle. Bank. We had Silicon Bank that we were talking about collapsing earlier last year. So there's always going to be something that feels terrible. That's why it's hard to invest in those moments. But if you get used to that, then you look at them as opportunities. Let me see what else to share here. Okay, so moving on to an article I was recently quoted in here that I feel like they did a good job. This is on Investopedia, tips for a successful retirement investing. Just let me make sure my stream is going okay here. Okay, cool. So article by Jonathan Ponciano, if I'm pronouncing that correctly, interviewed me and a bunch of other advisors, and I thought they did a great job. And I'll point out a couple quotes, and then we can look at some of the high points in a little bit more of a consolidated way. So advisor Eric Maldonado, founder of Aquila Wealth Advisors, says that one of the most common mistakes people make when investing for retirement is not giving themselves a chance to keep up with inflation. If you have years to invest before retirement, positioning yourself too conservatively with too many fixed income investments, bonds, or money market funds might not be enough to keep up with rising costs throughout retirement. So yeah, that kind of speaks to the correction we just saw. If everyone moves to cash and tries to get out of the market, it hurts twofold. One, that you don't get to be in the rebound, because if you're now investing back in after it bottomed out, you lost 1,000 points in the S&P 500 potentially. And the second reason it hurts is just because now you're not giving yourself a chance long term to keep up with inflation. And that's the real big challenge or kind of enemy, if you will, that we're trying to battle with retirement planning is inflation. And the other big one is longevity. Just we're living longer, which is a blessing, but there's always a blessing and a curse. And the curse would be that you have to have more money to live off of the lifestyle that you want. And if you're in money market or bonds, fixed income, by definition, fixed income isn't growth oriented the way profit generating large, small, international and emerging market companies are, real estate companies are. So you want to give yourself the best chance to have a fighting chance to keep up with inflation. Ultimately, Maldonado stresses the importance of knowing your overall risk appetite and working with an advisor to help manage emotions and investments, particularly during times of market distress. So yeah, of course, that's self-serving or biased on my end as a financial advisor to work with an advisor. But in those moments where there's a bunch of people kind of screaming fire, in a building, it's hard not to run and remember your fire drills. And that's where a financial advisor should come in the moment and be able to, separate you from panic or acting on panic. It's one thing to panic, another thing to act on it and either capitulate and sell or, do something that's just way different than what the plan is. I won't quote everything here, but and I think they had a pretty good graphic here. So this is a pretty good graphic that they put in here about just the power of compounding. And, we all know this, but it's just good to see every once in a while when you start earlier, of course, $10,000, you're going to end up with way more money when you're 20. And then every 5 years you wait to invest, you just end up with way less money. So 5% compounding when you're 20, 10,000 becomes 90K at 65 versus if you start at 50, it only doubles. 10,000 becomes 20,000. So you have to have handrails in place before the next big world calamity happens, says Maldonado. Know your numbers and have a buffer of cash equivalent holdings so you're not forced to sell growth investments during a downturn. So is there ever a case where, or is it always the case where you can never have bonds or money market? In other words, is it okay to have fixed income or money market or cash equivalent, a high yield savings account, something as a part of your overall net worth, as opposed to a part of your overall retirement plan? Of course, yes. I'm not saying that you have to avoid bonds and fixed income altogether in every aspect of your net worth, especially here in this case when you're trying to avoid a sequence of returns risk, which is just a fancy way of saying luck. You don't want to have bad luck when you on retirement day and have the next decade be a 10-year drought or sideways or even negative movement in the markets like there has been in years past. The 70s, the 2000s, the 30s, those have all been decades where in America, the US companies underperformed. And in those moments, you just want to give yourself a little bit of space, a little bit of margin, a little bit of buffer to not have to sell your shares of companies at the bottom, whether it's an ETF or a mutual fund or a target date fund. You're just trying to avoid selling at the bottom. So that, you do that by giving yourself some time by having money set on the sidelines, whether it's money market funds or, short-term treasuries, treasury bills, high yield savings accounts that just gives you 1, 2, 3 years. There's no, exact amount of money that's perfect. It's an art and a science. And that's not the only lever you can pull. You got to be able to go into retirement with some flexibility, knowing like, okay, if I need to work part-time, this is what I would do. If I need to cut back on my spending a little bit, these are some areas that I would cut back. Maybe I take one vacation instead of two. Or if you see the writing on the wall and you're almost retired and you're not quite retired, maybe you delay retirement by 6 months or a year, just so that way you're not shutting down your savings and having to pull out of retirement accounts at the bottom of a market. And it's hard to know when the bottom is, but you can start to get a flavor. Like, for example, in 2008, okay, by 2009, 10, 11, 12, you can see, all right, things are starting to recover. Even in 2020 with the COVID-19 lockdowns, you can get a sense of how things are going economically and just the Fed starting to print money essentially and think when are things going to start coming back. Let's see here. And then lastly, cautioning fees. So just knowing expense ratios in your investments, all that stuff, makes a difference. This is another good graphic that they put in the article here showing just the impact of the expense ratio inside your investment account. So like your 401k or IRA or taxable accounts, those all have expense ratios if you're invested in exchange traded funds or mutual funds or closed-end funds, just different funds. And 0.05 versus 2.5, how big of a difference that makes investing $10,000 over 20 years. So let me switch to showing a top 10 essentials for retirement investing, which is inspired by this article from Investopedia. I just kind of condensed it down a little bit and added my own spin on it, my own flavor. So top 10 essential tips for retirement investing success. AquilaWealth.com, that's my company. I'm a financial advisor, fee-only fiduciary, certified financial planner. You can contact us there or sign up for our monthly newsletters with commentary like this. This is education, not advice. That's a disclaimer there. So starting early, harnessing compounding. We kind of looked at that graphic before. Taking advantage of the ability to have more time. But start now. It's never too late. It's never too late to invest. And even someone who feels like they're behind the eight ball, if they're wanting to retire at 65 and they're 60, you still have decades in retirement to invest and even 5-10 years of, gazelle-like intensity, like Dave Ramsey calls it, except he uses that in relation to debt pay down usually, but you can use it in relation to asset accumulation and really start to get serious and put money away for your future. And then the snowball effect, it's just little by little, it starts to make a difference. Granted, sooner is better, but it's never too late. Tax advantaged accounts, pre-tax accounts are kind of our traditional, usual 401k, IRA. Roth accounts I'm a big fan of, especially sooner on in your investing. As Roth conversions allow you to move some of those traditional IRA accounts that went in pre-tax monies to tax-free withdrawal. You pay the tax in the year you convert. But, if tax rates get increased by the government, which most people anticipate they are at some point in the future because of how much national debt we have, then you have essentially insulated your retirement accounts from taxes by putting them into a Roth as far as withdrawing them withdrawing for an income in retirement. And then employer matches, you always want to get the match that's free money and take advantage of that if you have a 401k or if you're a business owner and you set up a 401k, you always want to do the matching, which is a tax deduction to your business. Taxable accounts matter. So I feel like brokerage accounts don't get enough press or good news in terms of their benefit to a retirement plan. A lot of people think like, oh, it's got to be an IRA or a 401k, but taxable accounts are an excellent way to supplement retirement income and plan for retirement income. Number one is the flexibility. You're not dictated by IRS rules on how much you can put in, essentially an unlimited amount into a brokerage account. And you could put estate planning aspects onto those accounts. You can have it be a joint tenant with rights of survivorship if you're married and it automatically goes to your spouse, or you can put beneficiaries. So if something happens to you and it's an individual account that you own, you can put instructions on who the money goes to or which charities or which kids and which percentages. Or you could put it in a trust account and the trust dictates the account instructions upon death. Early retirement, the taxable account is also really important because let's say someone wants to retire at 55. Well, you get penalized before age 59 and a half if you take money out of retirement accounts like 401ks and IRAs, pre-tax accounts, 403bs, 457 accounts if you have them, which is more like government entities. Those do allow you to take money out penalty-free upon leaving employment. And then tax advantage, there are still tax advantages to taxable accounts, even though they're called taxable accounts. The main one being that if you hold your investments for a year or more, you're now in long-term capital gain tax rate territory, which could be as low as 0%. Most likely it's 15%, but that's probably better than what your regular income tax rates are, which can go as high as 37%. Diversifying your portfolio, again, we've all heard it, but it's about implementing and putting in place the plan and knowing your goals and then sticking to the plan and adjusting as necessary. So stocks, bonds, I didn't put on this graphic here, but commodities, private equity, alternatives, real estate, those are all the main categories. As I read about in the article that I was posted in on Investopedia, stocks are the best way to keep up with inflation and your best chance to get the greatest return. There's a place for bonds in life to invest in, especially if you have a more near-term goal. Like let's say, you have a high schooler and you want to put some money away for college, you put in a 529 account. And, maybe as they get closer to graduating high school, you start pulling back chunks or all of the money into bonds just so that you have those funds available starting with each year of college. So for example, let's say when your kid starts freshman year of high school, you put the equivalent cost of the freshman year of college into the stable money market fund inside the 529. And then each year you keep adding the amount of money you need for the next year of college. So by the time they graduate high school, you have all 4 years basically set aside. So that way it doesn't fluctuate with the markets. Or maybe you want to buy a house and you put your money more in like fixed income because you want to do that in the next few years. But when you have decades, stocks just over time outperform bonds over decades, over centuries. I'm not saying we're investing for centuries. I'm just saying the data goes back centuries. Target date funds are kind of a way to kind of easily set it up if you don't have help or if you just want to pick something and just know that at least it's not in money market. I'm not a big fan of target date funds in general, just because it takes away some of the control you have with how aggressive you can be or want to be. Going back to that stock bond conversation, I think that if someone doesn't necessarily want to be all bonds or close to it by the time they retire, then you don't really want to be in the target date fund, because the closer you get to the target date of whatever you chose. So if it's a 2050 fund, and the closer you get to 2050, the more bonds and fixed income they're going to put into that automatically. Also, sometimes the expense ratios can be a little bit higher, so you want to be aware of that. ETFs, that's just a way to invest in stocks or bonds versus mutual funds or individual stocks. In general, I'm a fan of ETFs, especially the ones that track indexes, because the expense ratios are lower and they're a little bit more tax efficient, especially if you're investing in a taxable account. You're not going to get capital gains recognized on you as the way that you will with a actively managed mutual fund. And you get this 1099 surprise at the end of the year with taxes that you didn't sell on your own. Rebalance regularly. Again, this is going back to principles or just kind of essentials of retirement planning. Setting the course, essentially, just like a cross ocean freight ship. You got to keep redirecting or course correcting, because you're going to get knocked off course in the waves. And the waves here is the example is just how the markets fluctuate. So if you're invested globally, diversified, as well as different types and sizes of companies. Inevitably 1 year or 2 years or 3 years, one part of the portfolio is going to do better than the other, and you just got to make sure to sell. You're essentially selling when taking gains when positions do well, and you're buying into discounts when there's positions that go lower. So it's that age-old adage of buy low, sell high. And then sometimes you increase the risk without realizing it, because if you don't rebalance, all of a sudden you have maybe a huge portion of your portfolio in one idea like emerging markets, and you didn't mean for that to happen. And then that's just part of the annual review that advisors also should be doing with you. Taxes in retirement. So RMDs, required minimum distributions, which is age 73 now, but they're going to eventually go to 75 if the rules stay the same. That's for pre-tax accounts, IRAs and 401ks. You're essentially forced by the government to take out a certain amount of your money every year, whether you need it or not, because the government needs their tax revenue basically, which again is another benefit of Roths, because with Roth accounts there's no required minimum distributions, because nothing gets taxed on the way out. So why would they require you to take the money out, which is a reason for doing Roth conversions sooner than later, if it makes sense, and if it makes sense to do tax-free growth. Knowing your fees, we talked about that a little bit in the Investopedia article, but just understanding expense ratios. ETFs tend to have lower fees than mutual funds. Not always, but index funds tend to have lower fees because you're investing in an index and you're not paying a manager inside the investment account to basically pick positions, and you have to pay them as well. 401ks tend to have higher expenses, but not always. You can look at that. It's hard to sometimes figure it out, but there's not much you can do about that if you're wanting to use your employer's 401k, but you can roll it out as soon as you leave the company. Some companies allow in-service rollovers, but you never know. IRAs, that's the benefit of IRAs and taxable accounts, and solo 401ks if you're a business owner, and even 401ks if you're a business owner, because you can choose which funds to put in there and choose the lower cost one. And then advisor fees. I'm a fee-only financial advisor, a fiduciary, so I'm biased towards just transparency and advisors that get paid by the client only, as opposed to by being the representative of another company's products, essentially, which is under a suitability standard versus a fiduciary standard. Fiduciary standard is you have to do what's in the best interest of the client at all times. Suitability standard is best interest is you just have to do suitability is you just have to do what's suitable for advisors that are maybe duly registered, and they can charge a commission as well as charge advisory fees. So just understanding the fee arrangement and having it be transparent. I put all my fees on my website just so it's easy to understand, because it's just so opaque with a lot of these financial services, like especially insurance and annuities, and like who gets paid what, and or like some of these private equity funds or privately placed real estate funds. They just kind of show you the top line number, and you don't really know what your expenses are. Avoid emotional investing. Again, easier said than done, but with a financial plan and an advisor, you get help along the way. I'm not saying someone can't do it themselves, but that's what to me, the big benefit of an advisor is more the behavioral kind of counseling. Stick to the plan. Have a written policy statement, investment policy statement, which we do with our clients, which says, okay, this is where we need to be. This is how we're going to get there. This is what we're invested in. And unless the big goals change in your life, we really shouldn't be changing course much based on the economy of the markets. And then of course, having a recession buffer, which is that multi-year side fund, essentially, that can still be getting interest. I mean, even high yield savings accounts are almost 4%, or money market accounts. So that's the one benefit of having higher interest rates now, is that the savings actually have regular checking account or savings accounts. That some of these big banks aren't going to have much of an interest, but other places do. Income producing investments. These are, again, considerations within a retirement plan. Annuities, I put a fee caution here because you just always want to know what's in the annuity. I don't sell commission-based products like annuities, but there are some that are like immediate annuities, which kind of strips out all of the like bells and whistles that are hard to understand and that are charged for. And it basically is just as fundamental or straightforward as an annuity product as there is. You basically give the insurance company a lump sum, and they start paying you out right away a percentage of what you gave them. And you can do the math really quickly and say, okay, if they're giving me 5% of my money per year, then I need to, then hopefully I live for another 20 years. Otherwise I don't get my money back. Dividend stocks is another common income producing investment, which is taken into account into an entire investment portfolio. Consult a financial advisor. So just kind of knowing when to seek help. Usually people know when they need help, when it just feels like there's pressure, or they need help, or they just don't want to spend all the time studying all the different rules, or they just feel like they have a certain amount of money where it keeps them up at night, that they want to do it what's best for their family with what they have, or for their business, or just for themselves. What to look for, again, I'm biased. You want to find someone that's a certified financial planner and a fiduciary always, not just some of the time, and that is, transparent and easy to understand their pricing. Even ideally, it's on their website. Referral source is a great way to go if there's someone that you trust or a friend. That's always great to get a trusted referral source that can send you to someone that they like or that they vetted. But not everybody always has that, so you might have to do some interviews and go with kind of your gut experience as well as research. We're accessible at aquilawealth.com. I have my calendar on there, and you can schedule a call or fill out our contact us form and fill out some information and see if we're a good fit. Thanks for tuning in, and until our next live call. Now I got to figure out how to stop this thing.